Welcome to Mad Money. Welcome to Cramerica. Other people, my friends, I'm just trying to make you a little bit of money. My job is not just to entertain, but to educate. I got to put this stuff in context. Call me 1-800-743-CNBC. Tweet me at Jim Cramer. Bubble? What bubble? Today we saw what can happen when the real economy surfaces. We got some tremendous numbers from actual businesses, and I think we need to celebrate that so many companies not connected to the data center or artificial intelligence can be doing this well. And they're the reason why the Dow rallied 218 points. S&P was basically flat, and the Nasdaq, home of so much AI, dipped 0.16%. Why is this industrial strength so important? Because right now there's a perception that we only have two kinds of companies. There's the companies that are connected to the great data center build-out, and the speculative companies like the ones involved in nuclear power or quantum computing or rare earth minerals or some Bitcoin play that may or may not be a real business. Lots of people are repulsed by this market because they see it as being dominated by Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, Tesla, the Big Seven. I totally get that. Those stocks do make up about 35% of the entire S&P 500. When people see that level of concentration, they often think that, therefore, the market must be really dangerous. Others are repulsed by out-of-control speculation. When they see a market led endlessly by some uranium company with no earnings or a quantum computing play, Rigetti, that's struggling to make money for debt. Well, I mean, come on. That's not the market for them. I don't blame anyone who hates this kind of dual action. If there were really just two kinds of companies out there, then I, too, would be incredibly nervous. If, for example, OpenAI, a privately held company that's trying to dominate AI, somehow can't raise all the money it needs to build out a massive number of data centers, it could take the whole AI edifice, as the Wall Street Journal made clear, but I hope it's not a prescient article, down for the count. But what if there's another economy? What if there's a real economy? One that's trying so hard to beat a slowdown that seems to be engulfing so many sectors. If we can get some signs of life from the real economy, then I think money will flood into these stocks like it did today. And that would keep the bulls far from the slaughterhouse. And the bears would become endangered. Now, we got earnings from the big financials last week, and I was quite heartened by what they had to say. Wells Fargo put up extraordinary numbers, indicating credit quality is very strong. Bank of America showed us that the consumer spending and saving at terrific rates. We saw an extraordinary set of savings numbers from BlackRock and Morgan Stanley. Oh, what a quarter the Venerable Bank had. I like the Goldman Sachs quarter because they're starting to see a lot of good stuff from IPO and M&A advisory fees, although I feel like a lonely alum backing that one. Best of all, as I talked about last night, American Express reported a monster quarter that showed robust spending among younger people, very solid credit metrics. Wow. You know what? Okay, so the regional banks are not as strong. They need interest rates to come down if they want to do more business. It's true that JP Morgan CEO Jamie Dimon had to deal with what might be a fraudulent bad credit. His analysis is that if there's one cockroach, there'll be others. But aside from two other large bad loans, I saw fewer cockroaches this quarter than I can recall. Maybe the analogy's bad. More on that later. I don't want to freak people out about credit quality when we've had so few examples of bad loans. But it is perfectly reasonable to wonder whether the banks are doing better because we have a new president who's extremely pro-growth, with new bank examiners who allow more loans and easier credit. The Trump administration doesn't seem to want to regulate the banks. And regardless of how you feel about that policy, it's certainly good for the bank stocks. Today changed everything. We got some incredible earnings from really fantastic companies all over the map. And I want to recount some of them so you know I'm not just cherry picking. The best quarter today came from RTX. Yeah, the old Raytheon United Technologies. Defense contractor, commercial aircraft engine maker that's putting up staggering numbers. Why? RTX makes the complex military systems that are needed to defend our country and defend the countries of NATO. With the former getting special attention from the president, and the latter seeing more spending by its members away from the U.S. because of President Trump, it's perfect time for RTX. These guys are working overtime to replenish our missiles because we send so many of our stockpile to Ukraine. Management points out that while drones are important, you need a more comprehensive missile system as a deterrent to save a country. And you may need a golden dome at home to shoot down everything incoming. That's RTX. That's how a stock rallies $12, 7%. The quarter from 3M, it was superb. This company used to be a fan of new products. Then it got bogged down by all kinds of litigation related to forever chemicals that wreck groundwater. Now 3M is back to innovating. 70 new products launched in the third quarter, 196 year to date. The electronics and safety end market, after putting up slow growth for ages, both better than expected. As CEO Bill Brown in his tour de force quarter said, our third quarter performance gives us confidence we're on the right track and reflects the culture of excellence we're building inside the company as we continue to drive the rigor and up tempo necessary to deliver on our strategic priorities. End quote. Okay, that may sound like authentic Wall Street gibberish, but it isn't for those who know how low 3M had fallen. It's all you need to know is why 3M rallied $11.86, 7.66% today. Not to be outdone, GE Aerospace put up incredible numbers for commercial jet engines and, more important, aircraft service. That's where the real money is. The robust airline industry involves an incredible amount of maintenance, and GE Aerospace takes care of it. I was blown away by how CEO Larry Culp could put up yet another stellar quarter. You know what, though? After talking with them, I think there's more stellar quarters to come. Mary Barra's General Motors delivered a terrific quarter. Strong demand for trucks that are exceptionally profitable. The auto business may be benefiting from the president's laissez-faire attitude toward carbon emission. There's the president again, helping business. The electric vehicles, okay, not helping the skies, I get it. The electric vehicles don't make as much money as the internal combustion hybrids. That's the strength of GM. And I know that when you have a president that's not all in on EV, they are going to pull back because EVs lose them a lot of money. When you get strength in GM, that has tremendous pin action, which is how Nucor, the giant steelmaker, could rally nearly 3% today. Again, very impressive. Then there's Danaher, DHR, the life sciences and diagnostic equipment company, which has been a huge disappointment for my charitable trust for so long. Not today, though. Today, Danaher gave us the quarter we've been looking for with a promise that next year could be even stronger, and that's why the stock shot up nearly 6% today. Finally, is Coca-Cola. CEO James Quincey showed remarkable execution, bringing out even larger profits by taking share and offering new products that are selling quite well. So even though the real economy may be slowing down, these execs aren't letting that slowdown get in the way of good numbers. All day today, I heard people wondering if the strength in the market's real. I think that's a fair question to ask when we've got a rally that's being led just by the Magnificent Seven. But the bottom line, today we had a rally led by the many companies in the real economy that just put up excellent numbers. When RTX and GE Aerospace and 3M and General Motors and Coca-Cola and Danaher are all delivering strong results, you know something's going right. Not for the data center or the high-risk speculative stocks, but for the actual economy. House of pleasure. Jay in Connecticut. Jay.
Hey, hi, Jim. I want you to know that anytime I see your show, you're always like a breath of fresh air. You're really interested in people. So thank you for that. Thank you.
Oh, thank you, Jay. I appreciate that. I'm trying to do it a little different. Thank you very much. How can I help?
Yeah, true. Okay. I'll go real fast. I think it was last April, I got scared because what was going on in the White House and tariffs. So right. I sold my my Netflix and my Eli Lilly. I'm only going to talk to you about one thing. You said I could still buy the Netflix back, but I'm calling today about the Eli Lilly.
Well, Lilly, here's the problem with Lilly. They need to have something else to come out. They need something that's big that the insurance companies will cover for their drug. Because right now, a lot of people just feel, you know what? This Ozempic thing, it's played out. If you get something else, a new indication, that will ignite the stock. Mark in New Jersey. Mark.
Hello.
Mark.
Yeah, is that you, Jim?
Yeah, it's Jim. What's going on?
Hey, I've been dying to tell you that I'm a big, big fan and admire your enthusiasm and your search for the truth and for the straight and narrow, and going back to all the way back to the Cutler Cramer days. So
man,
been around for you for a long time.
Yeah, Lara's my partner for a very long time. Well, how can I help?
Well, I've been thinking about I'm an investor, and I'm thinking about this stock called Micron, and I was wondering what your thoughts were.
Okay, I like Micron, but it just had a parabolic move, and we can't buy parabolics. We have to wait for it to come back down. I think it's not that expensive because the numbers for DRAMs are coming up. But I do believe that you have to let that one have a little bit of break before you jump in there. And thank you for the really kind words. Okay, look, when you have companies like RTX, 3M, and Danner delivering strong results from all different sectors, you know something's going right for the real economy. And that's what we need to see for the stock market. Oh, man, tonight, Viking Holdings just accepted 2 more ships, hitting 100 ships in its fleet. I'm sitting down with the CEO to hear more about what the company has in the pipeline as Wall Street begins to fear a slowdown in the travel space that I don't see. Then credit concerns have entered the chat. So should investors be concerned that the other shoe is about to drop, or could these headlines be one-offs? I'm digging into the situation. And my CNBC colleague Andrew Ross Sorkin drops by. He's got a new book covering the stock market crash of 1929 and all of its ramifications. I'm hearing all that he learned while writing this fabulous book with the man himself. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Lately, we've heard a lot of hand-wringing about how demand for travel is finally tapering off. But not all forms of travel are created equal. Some are more equal than others. And that's why the cruise lines have been holding up incredibly well. They represent tremendous value. Take Viking Holdings. That's the parent of Viking Cruises, which is the world's leading river cruise play. So far, this stock's up more than 155% since it came public roughly a year and a half ago, including a 39% gain year to date. At these levels, Viking's within striking distance of its all-time high. So can it keep chugging higher? Earlier today, we checked in with Tor Hagen, the chairman and CEO of Viking Holdings, to find out. Take a look. Tor, I understand that congratulations are in order. You just did launch your 100th ship, and you actually commissioned 9 ships from really all around the globe.
Yeah, it's been a big day. You know, we've been in existence for 28 years, and to have reached 100 ships is not too shabby. We have been lucky, but we also done a lot of things right. But today was nice to show what an international company we are. We started the naming ceremonies in Cambodia. We've been to Luxor. We've been to Porto. We've been to Rostock. We've been to Paris, and now we're in Basel. So it's a really international company we have, and this, of course, on the rivers. But we, as you know, we have two types of businesses. We have the river business and the ocean business.
Now, it does sound like when you listen to those destinations that you come to mind that you have a great customer base, the strength of your guests. They want to go to places where they can learn, which is a terrific asset when it comes to Viking's, let's say, differentiation from the other cruise lines.
Yeah, we like to think of ourselves as different from the others. The others are, of course, many of the others are hugely profitable and successful in their own right. But, they're more, in the way I view it, I shouldn't talk bad about them, but they're more floating amusement parks. And for us, it's more of an adult education and enrichment. I think we even got some confirmation today. We had a guy who used to be a monk in Cambodia, and he thanked us for all we had done to establish school and so forth in Cambodia. It's, our guests are, as I said before, they're thinking people. And, as you grow up, you probably think more and drink less.
Well, you did return to China end of last year. You were at the Mekong. Now, I think when people think of the Mekong, they think, well, that is pretty isolated, pretty different. I don't know anyone else is going down the Mekong. I know people might go down the Mississippi. But these are things where you must have people who are studying and learning online, and also, of course, willing to pay a little more than a customer who wants to go to an amusement park kind of venture.
Yes, and of course it's for adults. We don't have children on our ships. So it's for adults, and we find, of course, as we open up these new destinations, it's people are queuing up to go there. So we need more capacity. But that is also the case on our ocean business. We do that differently from what other cruise lines do. You can say that we don't really like the word cruise so much because for us it's about the destination. Our guests like to explore new destinations, and they like to see real culture. And I think you can go to artificial islands in the Bahamas and do whatever people do on these islands. But for our guests, it's more a matter of how to get back into history and the things they've learned about it in school and would like now to experience firsthand. So I think when we see now what's going on, we have probably been a bit more fortunate than wise, but we see that our ocean business is there's been a lot of hype about the river cruise business and new entrants into that, so I said that must be very exciting. But we find that our ocean business is growing even faster than the river business. So you can say we have another 45 ships in total now on order, and the most of that growth will be in the ocean business.
Well, let's talk about that. I was trying to figure out how you would differentiate when it came to ocean, because the typical ocean voyage for some of these ships, I mean, for instance, the Norwegian cruise, they've got a section that is haven, where it is for a wealthier client. I mean, what do you have on ocean that distinguishes you from the others?
Yeah, that's a good question. I'm Scandinavian, and we are a bit what we call egalitarian, socialist, so called whatever you want. But we like people should be really treated the same when they're on board a ship. We don't believe in first class, second class, havens or heavens or whatever it's called, or non-heavens. Is when you are on a Viking ship, you're all together. It's part of the community. So I said we travel with like-minded people. Maybe that's a bit snooty or snobbish, but that's what we do. So come with Viking and you know exactly what you're getting. And it's interesting, we look at where we get our guests from. We showed some press people there a chart of where they come from. So we see that the new people who come to our ocean, the main source of business for us is people who have previously cruised on Royal Caribbean. I said, wow, that's interesting. Maybe we should get into the Royal Caribbean. No, I'm kidding. It's really what happens. People, of course, should go on floating entertainment parks when they're children and the like. But then they grow up, and they say, now I want to take my wife or my significant other, whatever, and have some serious time and go on a quiet, relaxed, non-pushy, small Viking ship. So we find it very, very easy, really, to take converts from.
It's obviously working. Your numbers show. Human nature says that let's be with each other. The numbers for this year virtually sold out already, more than half for next year. So there's clearly, it's a model that works.
It works. So, and you know, we are conservative people. So if things works, we don't change. So that's the whole plan. I think last time we reported, I think it was 64% sold for next year, for 2026. Which I think is quite unheard of, both the rivers and oceans combined. But the ocean business is fantastic too.
Well, I got to tell you, Tor, you've just delivered and delivered and delivered, and the stock's been great. That secondary performed very well. I've been recommending you since you came public. I want to thank Tor Hagen, CEO of Viking. Congratulations on having a great year, sir.
Well, thank you, Jim. And, you know, shares go up and shares go down, but so far we've been lucky.
I like that, and thank you very much.
Coming up, is the recent volatility in the regional banks a sign of bad credit? Cramer is digging into the sector and telling you where he stands. Next.
How worried should we be about bad loans? We started hearing about credit quality issues a month and a half ago, when an auto lender called Tricolor Holdings filed for Chapter 7 bankruptcy. That's the bad kind of bankruptcy, where you just liquidate the entire business. Tricolor specialized in subprime auto loans for undocumented immigrants in the Southwest. All right, not the ideal customer base in the current political environment. And there might have been fraud from the company itself. So it was easy to tell ourselves this was a one-off. But before September ended, we got another one of the sudden collapse of First Brands, an auto parts company which filed for Chapter 11 bankruptcy. Again, there was some chicanery here. Apparently, billions of dollars might be missing from the company thanks to some dubious off-balance sheet financing vehicles. There's a chance First Brands was double pledging assets as collateral for loans. And we heard some large banks might be on the hook here. Ever since First Brands bankruptcy filing, more and more people have been worried about the state of corporate credit in this country. Specifically, there's a lot of concern about private credit. These are like private equity firms, except instead of buying equity, they offer debt financing, mostly to privately held companies. Private credit's been red hot for years, with tons of money going into the space. And now there's a good chance that some of these firms started cutting corners and got sloppy with their lending. But at least in the case of First Brands, they borrowed most of their money via syndicated loans from regular banks. After a couple of weeks of turmoil, the market finally seemed to get over this one. But then JP Morgan CEO Jamie Dimon, the elder statesman of the financial industry, rolled out his cockroach theory of bad loans that I mentioned at the top of the show. When you see one cockroach, there are probably many more. And he'd know as his company took a $170 million hit from that tricolor bankruptcy. That's a rounding error for JP Morgan, but the cockroach comment suggests it might just be the tip of the iceberg. Those comments hit especially hard because the market was already on edge thanks to the 1-2 punch of the Tricolor and First Brands bankruptcies. And as always the case, JP Morgan was one of the first banks to report its earnings. Suddenly, investors had something to look for as the rest of the banks started to turn in the results. Within a couple of days, we got a pair of bad examples. Last Wednesday night, Zions Bancorp, which is a Utah-based regional bank, disclosed that it was taking a $50 million charge related to 2 commercial and industrial loans. Zions said they were pursuing legal remedies after finding, quote, apparent misrepresentations and contractual defaults by the borrowers and obligors and irregularities irregularities with respect to the loans and collateral. Chicanery, end quote. When that regulatory filing was published, it wasn't exactly clear who the borrowers were. But a $50 million hit to a smaller regional bank like Zions is a much bigger deal than a $170 million hit to a colossus like JP Morgan. Then the next morning, very morning, a different regional bank, Western Alliance, announced that it, too, was having a credit problem, this time with a revolving credit facility that it issued. Western Alliance named the borrower. It's a real estate investment fund called Cantor Group 5, and said that they'd initiated a lawsuit in August alleging fraud from the borrower. Now it turns out that Zions and Western Alliance were actually both suing the same party, a California real estate investor and developer called Cantor Group. Though Zions was suing some different funds managed by the company in question. Last Thursday, Western Alliance even said that it was providing the information about its lawsuit because Zions had made its own announcement, and they were starting to receive investor questions about their own exposure to this firm. But the combination of these two announcements sent the entire regional bank complex into a tailspin last Thursday, with the S&P Regional Bank ETF, that's the KRE, plunging a 6.2% in a single session. Huge decline. After the dual bankruptcies in September, Jamie Dimon's cockroach comments, and those 2 regional bank disclosures, well, investors were eager to shoot first and ask questions later. Well, since then, though, things have calmed down quite a bit. The KRE has been up for 3 straight sessions, and now it's only down about $1 or just over 2% from last Wednesday's close. There were no other big disclosures about credit problems from the rest of the regional banks. In fact, bank earnings were generally pretty strong. Last night, Zions Bancorp reported its full third-quarter earnings report, and the overall results were fairly solid, with a top-line beat, a better-than-expected efficiency ratio, and a 2-cent earnings beat. After noting the previously disclosed $50 million credit charge, Zions CEO Harris Simmons said, and I'm going to quote here, "We view this as an isolated situation resulting from a particular couple of borrowers. We have no further exposure related to these borrowers or guarantors. I would note that excluding the impact of this matter, net charge-offs were minimal at 4 basis points annualized on average loans, and credit quality generally improved for the quarter as well." Emphasis me. That went a long way towards easing the concerns about Zions, and the stock rallied over 1% today in response. At this point, it's rebounded so hard that it's down just 2.5% from where it was trading before management disclosed that credit loss last week. Hey, Western Alliance, by the way, reported tonight after the close, and everything looked fine there as well. The company did guide for an elevated credit charge in the fourth quarter, but investors were expecting much, much worse. But overall, after taking a closer look at all these individual credit issues that emerged over the past few weeks, I got to tell you, this really doesn't feel too bad at all. We simply haven't seen enough credit problems to be worried about any kind of systemic corporate credit risk. Instead, there have been 3 separate one-off situations, idiosyncratic they're calling it, with 3 borrowers that seem to have committed some type of fraud, leading to manageable hits for the banks that lent to them. Of course, look, we need to stay vigilant. We're flying somewhat blind at present, remember, without some of the most important government economic reports, so we don't have a clear sense of how the economy's doing. Some industries are definitely struggling, but the banks mostly seem to be doing pretty darn well. You don't get these kinds of earnings reports when corporate borrowers are defaulting left and right. But the bottom line? So far, the credit headlines from the past few weeks seem to amount to little more than a handful of bad individual situations. Could that change? Sure. And it'll tell you immediately I'm going to tell you when it feels like that's happening. But for all the fears about corporate credit these past few weeks, I just don't see it. Jamie Dimon, smart guy, says where there's one cockroach, there may be many more. He might be right. But for now, those additional roaches, they simply aren't showing up. Let's take some calls. Let's go to Sam in Pennsylvania. Sam.
Jim, how are you?
I'm good, Sam. How are you doing?
I'm good. You know, Jim, with the recent slew of bank earnings, I couldn't help but be intrigued by Wells Fargo given the recent lift of the asset cap that the Fed had on the bank. So I'm curious what you think about Wells Fargo with the current...
Okay, so I got to give you because I play with an open hand, Wells Fargo is one of the large positions for my trust. When it went up, it spiked. Both Jeff Marks and I said, you know what, we've got to trim a little. So we trimmed a very small amount. It's some stock that we bought in the 30s. So I can't tell you go buy it if I actually just sold some today. I happen to think the bank at 13.5 times earnings is very cheap, though. It's just that I can't have a huge position like I've been walking around with for Wells Fargo, as much as I like Charlie Sharp, the CEO. Look, I can't ignore the issues facing regional banks for the past couple of weeks. But for all the fear out there, I'm not seeing anything systemic yet. Hey, much more mad money ahead in this new book, 1929. Andrew Ross Sorkin, our own Andrew Ross Sorkin, compared NVIDIA to one red-hot stock of that era that defined the moment. I'm hearing more about what we can learn from that dark time on Wall Street with the author himself. Then, do you really know what you own? I'm sharing why it's now more important than ever to have a thesis on your holdings. And, of course, all your calls are rapid fire. Tonight's edition of the Lightning Round. So stay with Cramer. If you want to be a good investor, you need to understand what happens when things go horribly wrong. It doesn't get more wrong than the great crash of 1929, which led directly to the Depression. Last week, Andrew Ross Sorkin, the co-anchor of Squawk Box, editor-at-large of the New York Times Deal Book, and author of Too Big to Fail, The Authoritative History of the Financial Crisis, came out with a new book, 1929, Inside the Greatest Crash in Wall Street History. It reads more like a terrific movie than a piece of historical nonfiction. Everybody's in it. So let's take a closer look. Andrew, congrats on the new book. Welcome to Mad Money.
Thank you for having me, Jim. I'm so appreciative. This is so much fun.
Okay, so first of all, one of the things that was just extraordinary in the book was everybody was in the end.
Everybody was in. I mean, the whole culture was in this stock market, and everything that was happening here on this floor had taken over the entire culture. It was remarkable.
When you start off with the anecdote about Groucho Marx, which a lot of people don't know, that he got trashed by it. But then throughout, there's all these famous people who we thought were so smart, who were on the wrong side of the trade.
Look, everybody in New York, every member of the elite, the billionaire class, and by the way, not inflation adjusted, there were billionaires in 1929. People were making millions of dollars. People were trading. There were brokerages all over the city. You could walk into a hotel and trade. It was unbelievable what was happening.
And it's clear from you that at one point you say, look, the not-so-millionaires and the millionaires got along. There was actually hope that maybe capitalism was going to make everybody a millionaire.
I mean, it was a period of great transformation in this country. I mean, you had automobiles, you had telecommunications, you had, radio, the hottest stock, the meme stock. RCA was the NVIDIA of its time.
Everybody was in RCA.
Everybody wanted to be in, and these guys were trading. By the way, there was a specialist on this floor who ran RCA, and he was the celebrity down here.
It's just great. But all these people come to life. You make them all come to life. No one comes to life more than Charlie Mitchell, who clearly is the persona of the person who got everybody in and kind of ended up doing okay. I know the trial, but he ended up doing better than everybody else that lost money.
Charlie Mitchell worked just down the street, 55 Wall, corner of Pine there, and he ran a bank called National City, become Citigroup. By the way, his home, he lived up on Fifth Avenue between 74th and 75th, what is now the French consulate. That was his house. They called him Sunshine Charlie, and he was the guy who really created the idea of modern credit, that you could get a loan to buy stock. And he talked a lot about democratizing finance. He was Sunshine Charlie.
I know, and I talk a lot about democratizing finance, but I always have to be sure I don't run afoul of what he did, because I want people to invest.
Right.
And you do mention a book about Confessions of a Stock Operator that meant a lot to me in my first book. But I do want to point out there were some people, Leffingwell was a partner at J.P. Morgan. He comes off as someone who actually recognized that maybe things were getting crazy.
Oh, by the way, there were a lot of people who thought things were getting crazy. Charles Merrill of Merrill Lynch,
of Merrill Lynch,
1928, told people to get out of the market. Now, interestingly, the stock market went up from the beginning of 1928 to September of 1929, 90%.
Yeah. Oh, throughout it, you have these guys who kept calling it top, and they look so stupid.
I mean, that was the thing.
Right.
Timing is a very complicated thing. And then you had a guy named Carter Glass, who I think a lot of people know, who creates Glass-Steagall, which is the bill that breaks up the banks in 1933. He was like the Elizabeth Warren of his time, and he was railing, screaming about this idea of Mitchellism, how Charlie Mitchell was going to upend the entire country.
But in fairness to Mitchell, and I don't like to say anything good about him, Irving Fisher, this Yale economist, the number one economist in the country, was saying we hit a good plateau, right?
Absolutely. That was the thing. I mean, and by the way, that's what makes a market.
Right. Well, it's just a great tale, because one of the things that people didn't realize, it wasn't like there was one day. That month of October, which you detail, was just horrendous. And the market came back, but it never got back.
So that was the interesting thing for me. I think most people think there was like one terrible day in October. And by the way, then the Great Depression just happens. And it's just not true. It's a series of dominoes, if you will, and then a series of terrible policy choices in Washington afterwards about how to deal with the ramifications of it. And interestingly, the stock market by the end of 29 was only down 17%.
Wasn't that something?
Isn't that something? And so, but
where they got in, where people got in, and the fact that they were 10-1 in terms of the margin. So you had so many people like Groucho Marx who get a call in October, and he's effectively mortgaging his home. And so many people were hit so badly. All right. So I do need you to compare here.
Yep.
All in now versus all in then. What's the difference? Maybe it parallels?
Okay. So the good news is there was no SEC then.
Right.
Insider trading. By the way, that was okay. That was fine. There was no capital requirements. There was no Banking Act. A lot of the rules that hopefully are the safeguards that have kept us safe for the last 100 years are been in place as a result of that. I also like to think a lot of the lessons that we learned in 29 were learned, by the way, in 2008 by Ben Bernanke, who, by the way, his PhD at Princeton was on the Great Depression. And what was the lesson? You have to, unfortunately, throw money at the problem.
Right.
Don't pull back.
Hoover was so against that.
They were
Mellon, oh my God, he had the most conservative group of people. But you detail all this stuff.
So you're in the room with these people, and you actually get to see the decisions.
And I did feel like I was in the room.
I mean, to me, just that was what I was going for. Right. That if you could actually see the way they were feeling and why they thought what they thought, it makes it understandable.
Okay. I wasn't going to say this in a minute. I felt sympathetic for Hoover. I'm not kidding.
Yeah.
I think Hoover was the zeitgeist. He was trying to do what's right. He knew that people were bad off, but he didn't know how to. He felt just, you toughen up.
He thought it was a psychological problem. Right. He thought he could jawbone his way out of this thing. But he also then made a bunch of poor choices. He decided to raise taxes at the worst time.
No, he did it all wrong.
By the way, the tariffs, talk about parallels.
Smoot-Hawley
tariffs, we have them now. So there are things that are happening in our economy, too, that we need to watch out for as well.
Absolutely. Well, okay, if you were fascinated by the markets and fascinated by history, this is it, okay? Andrew Ross Sorkin, co-anchor of Squawk on the Street, author of 1929, which is on sale now. Hey, listen, you can mark it up like I did and get a lot out of it. Mad Money's back after the break.
God bless you.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
Time of the light round. Rapid calls to the top. By myself, just your questions. Anybody plan us down. And then the lightning round is over. Are you ready, Ski Dad? Time for the lightning round. Cravers of money. Let's start with Stephen in New York. Stephen.
Uncle Jim, what's going on? Booyah, buddy.
Booyah. Thanks for calling, man.
Thank you, sir. Big Daddy Backnasco from Ronkonkoma, New York. Big fan,
All right,
Jimmy.
Yeah. All right.
Few things said. You said it best. Uncle Jimmy, you changed lives. That's what your show is all about.
Oh, thank you, man.
Thank you, sir. Got a question regarding ASTS Space Mobile has partnered with...
See, this is the kind of company, all right, this is what I hate. I know that they filed a big convertible after the close. That is exactly what I'm most afraid of. That's an equivalent of a big corporate finance. It's going to push the stock down. That's what I'm seeing with a lot of this speculative stuff. No. Let's go to Frank in Florida. Frank.
Yes, Jim, a long-time listener.
Thank you.
TMQ, hold or sell?
It is a parabolic move that's just now declining. You got to sell that thing. Let's go to Dan in New York. Dan.
Yes, hi. Jim, I've been watching you for years. You are wonderful. You are great.
Oh, thank you. Thank you, buddy.
I have a question about a stock. It's called Grail, ticker symbol GRAL.
Right.
And it's a medical company that's developed tests.
Yeah, and I just read a really good piece the other day written by Dr. Topol, who's been on the show a number of times. It did not make me feel that it was worth I just didn't think it was worth owning after this very big parabolic move. I'm going to say absolutely not to that one. Let's go to Kyle in New York. Kyle.
What's going on, Jim? Kyle from Long Island here. Thanks for having me on. I'm a big fan.
Oh, sure, absolutely. What's going on?
My question is on Tecogen, ticker TGEN. They signed a letter of intent with Vertiv for over 500 megawatts of natural gas.
It could be good, but they're losing money. It just had a giant move up, anticipating exactly that. I'm going to have to say I'm taking a pass. Let's go to Sal in New York. Sal.
Jimbo, what's up, brother, man?
I don't know, man. A lot of spec stocks. Okay, what's up?
Hell yeah, let's do it. All right, I got one of the leaders, if not the leader, in the autonomous trucking space with heavy backing from an array of companies like Amazon, Uber, Toyota, and your favorite, Jim, ding, 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 NVIDIA. What do you think? And I'm just going to say this. I'm not going to speculate, but I'm just going to say this. It sounds like there could be a Trump administration stake in this company. I am speculating a little bit. But you know what? Who knows? What do you think about Aurora Innovation, Jim?
Yeah, it can't seem to make money. I can't recommend stocks at this time that can't seem to make money, and they are definitively, even with those bloodlines, not making money. Let's go to David in Illinois. Dave.
Jimbo, how you doing?
I'm doing good. How are you, Dave?
Good. Hey, listen, I want to talk about this quantum computing stock, RGTI. Sure. This company.
You mean the one that just had a giant seller, a giant insider selling? A director? No, I don't want to be there. Giant insider selling does not work for me. And let's go to Brad in North Carolina. Brad.
Hey, thanks, Mr. Cramer. Thanks for taking my call.
Of course. What's up?
I'd like to know what your opinion is on GLOB.
GLOB. I don't know that one. I'm going to have to do some work on that one. I don't know that player. Let's go to David in New York. David.
Hey, Jim, how you doing? I'm calling
doing well.
Beautiful Southampton. Thank you so much for all you do. I'm calling about a company called Innodata, symbol INOD.
Yeah, digital content. I actually like this company. It's a very high priced earnings multiple, but it does at last make money. I at least got to end the call. Got to have the lightning round on one company that seems like a very real company. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, Cramer's teaching you how to make money in any market and laying out some warning signs to watch out for when investing in speculative names. Next. Tomorrow, kick off the trading day with Squawk on the Street. Live from Post 9 at the NYSE.
Oracle is basically the credit wrapper for OpenAI.
Some of it, David. Not all of it.
Some of it. See,
wow, I like the editing. You guys editing each other in real time.
Good.
This is the most exciting market.
And by the way,
and you're
for the benefit of our viewers, because Jim is absolutely right. Some of it.
It all starts at 9 a.m. Eastern.
What does Oklo really do anyway? How about the New Scale Power? What does QBTS stand for? Should I buy more GLD? Time to average down on Red Cat? If these questions cross your mind today, then I think you need to recognize that you're not investing. You're speculating, and you're speculating poorly. We've had a huge wave of debt-fueled speculation that now threatens to wipe out your savings in a heartbeat. These stocks have been moving straight up for a long time now, and there's a huge cohort of people who only know how to chase them and nothing more. So first, let me make something crystal clear. When you have big gains in a stock, you haven't actually made any money until you sell something. At this point, it's vital that you take something off the table if you own stocks like I just mentioned. It doesn't have to be your entire position, but at least take out your cost basis so you're playing with a house of money. Second, while I actually condone speculation in my new book, How to Make Money in Any Market, you know what? I say you got to do it wisely. What does that mean exactly? Simple. It's okay to speculate in these high-risk stocks, but you have to know what the company does. You have to know how it makes its money. Is it making money? Is it doing something proprietary? If the valuation can ever be justified by potential profits down the road, or will there never be? You can't just buy these things merely because they keep going higher. Someday that stops, and you won't know what day that is, and you won't know what to do unless you've done some homework. If you weren't doing the homework, today was your worst nightmare, because you found out that your whole portfolio of speculative stocks is linked together. That's right. I knew today would be a fulcrum day, a day where things would reverse, because gold had been at the heart of the speculative bubble of late, and when I saw it start to roll over, closed down more than 5% today, following the extremely speculative silver, which shed 7%, I realized the entire spec complex would just get hammered. Why? Because lots of people buy these things with borrowed money, and the people who are in gold are likely to be in many other speculative situations because it moved viciously. When you buy something on margin and it goes down, you need to raise money. And you usually do that by selling other stocks. And that's why these specs tend to trade together. Terrible pin action. How can you tell if you're in a dangerous stock? Oh, just look at the trajectory, please. If it looks like the right side of a parabola, something that turns into almost a straight line going up, then you need to worry. If you see a parabolic move, history says you're likely to get smashed. Because when something goes wrong, these things will come down even faster than they went up. When I see one of our holdings in Travel Trust go parabolic, you know what I do? I take profits immediately. Sell. Now, a lot of people don't want to hear anything that I've been saying. I spend a huge amount of time in How to Make Money in Any Market explaining how to do the homework for specs, how to assess a company and its stock. I do that because I need you to understand what you own so you know what to do. If you don't understand and you get a day like today, you'll have no idea what to do. In these situations, it's human nature to pray and to hope. Maybe it'll reverse, even as prayer and hope has nothing whatsoever to do with the process of investing. The stock will then drop and drop and then drop some more until it's below your cost basis. If you bought it on margin, you'll be cashed out, having turned a gain into a loss, or you'll just sell and give up, and then you'll end up being, let's say, losing a lot of money because you'll sell a lot lower than you bought it. So if you can't describe what a company does and how it makes money, assuming it makes money at all, then I got to tell you, it's not too late to sell. Nail down those profits with these specs, please. Live the play again. Because if you stick around, there's a good chance you'll lose all of your gains. And if you borrow money to buy these things, you'll lose a lot more than that. I like to say, as always, bull market summary. Pumps are fine just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.